Welcome to another DYF investing video. We are so excited to bring this video to you because today we finally introduced the concepts and strategies that are the entire basis of our website, value investing. Value investing has gotten a lot of attention in the last couple decades, due in part to a man named Warren Buffett, arguably the most successful value investor of all time. Now, Buffett didn't invent value investing. In the 1940s and 50s, he studied under a man named Benjamin Graham, and it's Ben who is considered to be the father of value investing. So as an investing strategy, value investing has been around a long time. It's proven itself relevant and effective through the booming bull markets of the 1970s and the 2000 teens, but more importantly, it remained effective and brought investors safely through the nasty bear markets like the Great Depression and the dot-com bubble in the mid-2000s. It's a rules-based strategy that teaches investors to make rational and logical decisions based on data, not hunches, trends, prices, or fear. With a long-term focus, value investors focus on finding healthy, solid, or what Buffett calls wonderful companies to buy. This is a strategy that takes a markedly different view on buying and selling stocks from that of an active trader. If you saw our last video that discussed the differences between active trading and investing, you know that an investor wants long-term investments. If you could buy stock in only 5 companies and had to hold on to them for the rest of your life, you'd certainly want to choose really good, strong ones that can thrive well into the future. As value investors, we're not looking for companies to burn by buying and selling quickly, and we aren't interested in those long shots that may or may not survive. Instead, we want to find companies that can withstand bumps in the economic road, like a recession, a pandemic, or even a juicy scandal. So what constitutes one of Buffett's wonderful companies? In general, there's a few things you want to look for. Relatively low debt, consistent profits, healthy growth, good cash flow, strong management, a strong presence in their industry with a good brand recognition, and lastly, something that's called a good moat, meaning the company has a solid stronghold and is pretty well protected against competitors or other pitfalls that would cause a company to go out of business. Now, if you want to know more about why those 7 things are important and how they all contribute to a moat, we have another video that goes into that in a lot more detail. But for now, just understand that a value investor is looking for companies with as many of those qualities as possible. Those are what make wonderful companies. And you might notice that that list doesn't even mention stock price. That's because unlike traders who pay attention to stock prices almost exclusively, a value investor's first priority is reducing risk. An active trader may enter into a purchase knowing there's a high chance of losing money, a risk they're willing to take. But if we listen to Mr. Buffett, who is famous for saying the first rule of investing is don't lose money, then buying a stock with a high chance of losing money is not even an option. One of the best ways to reduce risk is to find the companies that meet all those criteria, or as many of them as possible. Because when a company has all or most of these things, it demonstrates a lower risk of failing and a higher probability of thriving, making it a good company to own. Which brings us to a really important piece of value investing, and that is valuating a company and figuring out when to buy it. If active traders want to buy low and sell high, then the value investor wants to buy on sale. It's not really about low or high specifically, but about value. How much is the company actually worth compared to what it's selling for? Our current housing market provides the best example of this. The first few years we owned our home, the price stayed pretty stable. It was worth about what we paid. But in the last 2 to 3 years, its value suddenly doubled. Now, my home didn't just suddenly get better. We didn't remodel, we didn't do any updates. It's the same house we bought. But things like increased demand, the pandemic, and the economy all caused the home in our area to go up in value, making them overvalued, because they're selling for much more than they're actually worth. Stocks can be overvalued too, for many of the same reasons. Maybe a company gains really positive attention and suddenly everyone wants to buy their stock. That demand will cause the prices to go up artificially. Once things settle down, the price is often correct back to what they're actually worth. This can happen the other direction too. When a home or a stock is undervalued, it costs less than its actual value. It's said to be on sale. For a home, this could be the result of someone who needs to sell really fast, so they list it for less than it's worth just to sell it quickly. Stocks can also go on sale. Let's say a really good company is hit with a lawsuit. Once people find out, they might panic, believing the lawsuit will cause the company to go under. So they sell off all their shares. When no one wants something, what happens to the price? It tends to drop. But the price didn't go down because the company was suddenly less valuable. It went down because people panicked and everyone was afraid. And if this is one of those wonderful companies with all the qualities we mentioned, this is a great time to buy because all the data would suggest this company will survive the lawsuit and the stock is actually worth a lot more than it's selling for. And it's this idea of determining the true value of a company but waiting until it's on sale to buy that sets value investing apart from most other investing strategies. So again, the two things a value investor is looking for is a wonderful, healthy company whose stock price is on sale and undervalued. Sound hard to figure out? It might sound like it, but it doesn't have to be. DYF Investing has several more videos explaining all of this in greater detail, showing you all the steps and the data required to determine whether a company is wonderful or not. We also have videos on how to evaluate stock prices and how to know when they're on sale. And we also have a website that does a good portion of this work for you because we get that doing it on your own is a little intimidating and can be pretty time-consuming. You'll see that when we list company stock prices, we indicate which ones might be undervalued, saving you a great deal of time and math. You're always welcome to double-check by hand, though, and see if you agree. But just because it's undervalued doesn't mean it's a good company to buy, which brings us to the DYF score, something that sets us apart from all the other investing websites out there. This score gives you a tremendous head start on finding those wonderful companies. It's based on over a dozen data points, all associated with the potential health, strength, and viability of a company. In general, the higher the score, the greater the potential for that to be a wonderful company that might thrive into the future. Of course, the score cannot account for everything, so there's still quite a few decisions that you as the investor need to make. But it's a great starting point when looking for potential companies to research. And it's these two things that we are so proud of. Because as you'll see in future videos, crunching the numbers to find the wonderful companies, then determining the value takes a lot of time and effort. It's very doable. Once you learn how, you can absolutely do this on your own. But again, it's time consuming, and we really want to help you with that. If you like what we have to say and are interested in investing successfully on your own, come check out our website. We believe that we've made it easier and much more accessible to the people that may not have the confidence or the time to run the numbers, but who still deserve the opportunity to invest.